What is up, everybody? This is Brian. Just going to do a quick video on gamma and gamma exposure and how options positioning affects the market. Quick little disclaimer, no options expert. To me, they're still very confusing, but the way I use it, it's pretty easy to understand and it's very useful in my trading. So first, we have to understand what delta is. Delta is the change in options price due to the change in the underlying. Delta is dynamic and it changes with movement. As the price of the underlying goes up and down, the delta is also changing. Delta ranges from -1 to 1. And the key to all of this is this next point. Market makers need to remain delta neutral at all times. And they do this by hedging their delta. And the product that they use to hedge their delta is ES futures. The market makers try not to have any directional risk. So in order to do that, depending on their options positioning, they need to buy or sell X amount of futures throughout the day in order to remain delta neutral. So depending on call or put, calls up top, puts are on the bottom. If you are at the money, you have your delta value is 50 or 0.5. Puts, it's just negative, so negative 0.5 for at the money. If you have a call, if you're long a call, let's say, and the underlying is increasing or going higher, your delta on that option is also increasing. The more it goes in the money, if it starts going down out of the money, then your delta goes down as well. For put, if the price of the underlying goes up, the delta loses value, so it goes more towards 0. And if it goes in the money or if the price goes down, then your delta gets more negative. At expiry, your delta is either 1 or 0, depending on if it expires in the money or out of the money. And same thing for the put, it's either 0 or -1, depending on where it expires. So what is gamma? Gamma is just the rate of change of delta. It measures how much delta shifts when the underlying moves. And just like delta, it ranges from -1 to 1. And gamma is highest for at the money options. So this is the curve of delta, and this is the one for gamma. So if we have a either call or put, and we are at the strike price or right at the money, our gamma value is going to be the highest. And as we go in or out of the money, our gamma is going to be decreasing. So there's different things that affect the gamma. The main three that I look at are time to expiration, spot movement, and net positioning at each strike. So with time to expiration, gamma increases as the time to expiry decreases. So 0 DT options are going to have more gamma than an option expiring in 5-6 days. And as the day goes on, the gamma for the 0 DTE options are going to increase. So an option could have a gamma value at 9:30 of, let's say, 0.05, and at 3:30 p.m. that gamma is going to increase. Next thing is spot movement. So like this is showing this chart here, gamma is at its maximum when the option is at the money. So no matter what it is, if we're trading at the strike price, gamma is going to be the highest. And then net positioning at each strike. So if there's more options open at that strike, gamma will be more. So it's kind of like a cumulative effect. So the more number of contracts open at that strike, the more gamma there's going to be. And vice versa, the less open contracts, the less the gamma. And there's a lot more things that go into this, like implied volatility or interest rates and all that, but it's not very useful for us. So depending on the option position, the trader or the customer, as they call it, is going to have either positive or negative delta and positive or negative gamma. Positive or negative can be interchanged with long or short. So if you're positive delta, you're long delta. If you're positive gamma, you're long gamma. And then same thing on the other side. If you're negative delta, you're short delta. And if you're negative delta or negative gamma, you're short gamma. So just basically the same thing. They just can be used interchangeably. So understanding what options position has what delta and gamma is very important. So if a trader is or a customer is long a call, they have positive delta and positive gamma. If they're short a call, they have negative delta and negative gamma. If they're long a put, they have negative delta and positive gamma. And if they're short a put, they are positive delta and negative gamma. And then based on what the trader or customer, and this just refers to anybody that's not a market maker, so it could be retail trader, it could be banks, it could be a fund, different institutions are considered customer positioning. Market maker, same exact thing. Long call, they still have positive delta, positive gamma, etc. But the key here is depending on what the trader or the customer position is, the market maker has to take the opposite side. So if the customer is long a call, market makers are short that call. So if they're short the call, they have negative delta and negative gamma. And depending on that, that affects their hedging behavior, which go to the next slide, goes through all that. So first one, if the trader buys a call, market maker sells them that call, so they are short that call. So the market maker has negative delta and negative gamma. And depending on if they have negative or positive gamma position, they will hedge differently depending on if the market is rising or if it's falling. So if they have a negative gamma position, as the market goes up, they need to hedge their delta by buying the underlying. So they buy ES futures as the market goes up. If the market starts to fall, because they have negative gamma, they will begin to sell the underlying or sell ES futures on the way down. If the trader opens a short call position, market maker take the other side, so they're long that call. Now they have positive delta and positive gamma. So as the market rises, in order to hedge that delta back to zero, they need to sell the underlying. If the market begins to fall, the hedge that they need to do is they need to buy the underlying. And then same thing with if they're short put, they have negative gamma, which means they buy the underlying as the market goes up, they sell it as the market goes down. And long a put, they have positive gamma, so they sell on the way up and buy on the way down. So I'm just going to run through another example. There's two different ways the market maker hedges. At the time of the trade, that's what they call the initial hedge. So if a customer is long a call, means the market maker is short the call. So the initial hedge is to buy the underlying. And that's because short a call, that means they have negative delta. So in order to get that back to neutral, they have to buy the underlying. And since they are short an option, short a call, they also have negative gamma. So the continuous rehedging, as they call it, is as the market goes up, their delta is decreasing. So in order to hedge that to neutral, they must buy the underlying. If the market is going down, their delta is increasing. So in order to hedge to neutral, they must sell the underlying. So positive or long gamma is one environment we can be in, or the market maker can be in, and negative short gamma is the other. So if you are long an option, you own it. You have a long gamma or positive gamma position. So whether you're long calls or long puts, you have positive gamma. So as the market goes up, the delta goes up. It's getting more positive, and because of that, you have to sell futures to remain delta neutral. As the market goes down, your delta position goes down. It's getting more and more negative. So the decreasing delta means you have to buy futures to remain delta neutral. And negative gamma means you are short an option, meaning you sold it. You're short gamma or negative gamma. So in order to hedge this, as the market goes up, your delta is going down. It's getting shorter, more negative. So as your delta goes down, you must buy futures to get back to neutral. As the market goes down, your delta goes up. It's getting longer or more positive. And as your delta goes up, in order to offset that increase in delta, you must sell futures to get back to neutral. So depending on if the market makers have net long or short gamma or positive or negative gamma, that's going to dictate the hedging response by the market makers. So if they're positive gamma, market makers are hedging by selling on the way up and buying on the way down. So they are trading against the flow. This produces a more stable environment. Sometimes you get a lot of chop. The ranges for the day are smaller, and the volatility is decreased. With negative gamma, it's the opposite. So market makers hedge by selling on the way down and buying on the way up. They are trading with the flow to hedge their delta. This creates a destabilizing environment, increased volatility, sharp moves, bigger ranges, and the negative gamma acts as an accelerant. So the past, basically all of last week, we were in a negative gamma environment. So that's one of the reasons why we saw, 100+ point days for multiple days in a row. It's because the market makers were short gamma or negative gamma. So they kind of accelerated the move. So whenever we were selling off, market makers were hedging by selling futures. So that, increases the selling pressure. And anytime we moved up, the market makers would be buying on the way up to hedge to the delta. So that causes the sharp up move. Negative gamma goes both directions. So just because we're negative gamma doesn't mean we're going to be selling off. It also increases the up moves as well. So here we're going to move on to, before I get into the next part, we're going to show what the platform I use and how I use it. So it's called Options Depth. They have a bunch of different tools that I use each day. One of them is what you're seeing now, which is the gamma heat map. This is for today, November 28th. Not really a good example because it's a half day and no one's really trading, but so basically what this shows is the gamma environment that we're in. The red-ish background means we're negative gamma. This black solid line is the flip from negative to positive gamma. The green lines that you see are local gamma peaks. So basically like a maximum gamma value where gamma is the highest. And the red lines show local negative gamma peak. So where negative gamma is the most. If you hover over and you look in the top left, there's a value. So that is showing the amount of gamma at the price. And like I was saying before, if you look at the start of the day, the values are pretty small. And if you look at the end of the day, which is over here, the gamma increases. And that's because as the options expire, the gamma increases. The next thing that I use is called the charm heat map. So it's basically the same thing as the gamma heat map, but it's showing charm. And charm is just the delta decay as the day goes on. Blue is a supportive environment, and this orange yellow is a suppressive environment. So what that means is if we are in a yellow area, that just means as the day progresses, market makers need to hedge their delta by selling futures. And it's the opposite for the blue area. If they're in the blue, as the day goes on, they need to buy back futures or buy futures to hedge their delta. Charm is a very passive flow. Um, the way I like to think about it is if nobody else was in the marketplace and price action was just driven by charm, if we're in the yellow area, we will sell. And if we're in the blue area, we will buy, because in the blue, market makers need to buy. In the yellow, market makers need to sell. And just like the gamma heat map, we have these areas where it flips from being suppressive to supportive. And then the last thing that I use is the breakdown by strike chart. So there's different ways to visualize the data, but basically it just shows you at each strike what the positioning is. So I have this set to market maker. So this is showing what positions the market maker has. So for example, if we zoom in at 68.40, they are long 7,679 calls. And if we switch it to puts, these are the put positions that they have. And then what I mainly look at is the net positioning. So what this is showing is if the bar is to the right or if it's blue, that means at that strike, the market maker is net long options. So 68.40, they're net long 6,512 options, and that's mainly coming from calls. And then 68.10, net long options. If the bar is to the left or if it's yellow, that just means they are net short options. And what that means is, like I was saying before, if you're short options, you have negative gamma. So on the left would be negative gamma positions or short positions. On the right, they would all be positive gamma positions. So if we switch this from position number to gamma, it will correspond to the net positioning. The bars are much smaller because, like I was saying before, as the day goes on, gamma increases for at the money. So that's why these bars are all the biggest, and the ones out of the money to the upside and downside are small. So going back, another thing that I look at is speed. So speed refers to the correlation between spot movement and gamma exposure. So there can either be positive speed or negative speed. Positive speed just means there's a positive correlation between spot and gamma. This acts as resistance as we go higher. So if price is going up, gamma is going up. This will make it harder for price to go higher because the higher we go, the more market makers will be selling to hedge. And if price goes down, gamma goes down. So this will make it easier for price to go down because the lower we go, the less the market makers will be buying to support the price. And then opposite is negative speed. So there's a negative correlation between spot and gamma exposure. So in this case, it's supportive as we move lower because if price let me go step by step. If price goes up, gamma goes down. This will make it easier for price to go higher because the higher we go, the less the market makers will be selling to hedge. And if price goes down and gamma goes up, this will make it harder for price to go down because the lower we go, the more and more market makers will be buying futures to hedge. And a little display here. So if price is here, we're in a positive speed environment. The overall backdrop is blue, so we know we're in positive gamma, but we're also positive speed. So as we are going up, as price is moving up, gamma is moving up, as shown by the darker blue color. So as we go up, market makers are selling more and more. So it's going to be harder to go up than it is to go down. In a negative speed environment, if we are, let's say here, as we go down, the gamma value is increasing. So the market makers are buying more and more on the way down. So that will stabilize price and it will be harder for us to go down. If we then start moving up, it's easier to go up because they are buying or they are selling less and less as we go higher. And then flip side, if we start selling from here, it's going to be easier to go down because there's less buying by the market makers as we go lower. So this green line, gamma peak, so this, if we're below it, acts as resistance. If we're above it, it'll be acting as support. So if we're below it, expect some type of resistance until we break above it, and then it flips to support, because as we go back into it, market makers are buying down here at the most of their buying is happening here because the gamma value is the most here. So how I use the heat map, it's pretty simple. The main thing that I look at is what environment we're in. So what is the color of the background? If it's red or like a light red to white color, I know we're negative gamma. So what does that mean? Expect price to be more volatile, expect potentially bigger moves. If I'm in a trade and we're in negative gamma, I would most of the time set wider targets than usual because price has a better chance of, having a bigger move because the market makers are hedging with the flow. So if we start selling, market makers are selling with us. If we start buying, they're buying on the way up. If we were in a positive gamma environment, then denoted by the blue color, blue background, then if I'm in a trade, maybe set smaller targets, because as we go up, market makers are selling. As we go down, market makers are buying. So that's what causes the choppiness or the less volatility, the smaller moves that we see when we're in positive gamma. Another thing that I look at is the gamma peaks. So where those are on the heat map, those are either going to be the biggest resistance points or the biggest support areas. So it's always good to know where the market makers are going to be stepping in the most. Charm heat map, there's not much to it. Really just look at the color of the background, and that could give you a sense of, potential drift of where we're going to go. If it's blue, again, charm is a very passive flow. It's not that impactful, but it's good to know, what the market makers are doing as the day goes on. And then the breakdown by strike, what I look at is the largest positive nodes. So this was from the other day. So 6,800 would be a large positive node that I'd be paying attention to. This one down here, and then this one down here. So if price is where it is right now, the red line, I would expect once we get up to this level, potentially stall out until we clear it, and then look for it to be support. And then this one would be the next one to pay attention to. If we were to come down into this one, again, expect it to be some type of support for a potential bounce. Or if we fail, then once we get below, look for it to be resistance for a move lower. So the positive nodes kind of act as support and resistance depending on where we are. And they are also pretty magnetic in nature, just based on the hedging dynamics from the market makers. So if we start trading into one, price will oftentimes get pulled to it. And then either we stay here or we break in one direction. We either go up. The positive nodes are pretty impactful later in the day. If we're trading at a very positive node, a lot of the time we'll just stay there for the rest of the day. So this is looking at net positioning. It's the same thing with gamma positioning, and gamma will be correlated. If there's more positioning, there's more gamma. But you also have to keep in mind that depending on where spot price is, the gamma will be more or less. So in this one, we have most positioning at 6,800, but the gamma at 6,800 is not a lot because we're pretty far away from it. But just like the positioning, positive gamma nodes will act as support or resistance, and they will be magnetic in nature. So the key takeaways, knowing what gamma environment we are in can help with price expectation. Will we have a big move, small move? Will it be choppy? Should we aim for wider targets? What kind of volatility are we going to have for the day? And this is known well in advance. These heat maps are calculated at the beginning of the day. So as soon as the market opens, you know, are we positive gamma? Are we negative gamma? And as soon as the market opens, we know where the positioning is located. So we know where we could potentially drift to, where the support points would be, where the resistance would be. And like I just said, where the positive nodes, these will act as support, resistance, and magnets for price. What is charm telling us? Is the passive flow supportive of the move? Are we in a suppressive charm environment? And, you know, big thing here is this is not a myth. Market makers must hedge their delta. And by having this information, we know where they will step in and how much they will be buying or selling. Using this on its own, I mean, it is possible, people do it, but using this in confluence with your trading system can be a very powerful tool. So no matter what you trade, this can be helpful. And one thing I will say, I know there's a lot of different platforms out there that do this kind of stuff, but Options Depth, which is the one I use, Spot Gamma, which is another one that I've tried out, and then there's a new one coming out called VS3D. To my knowledge, they're the only ones that are doing it correctly. A lot of the other ones use the naive approach, and what that means is they're just assuming that all puts are bought by customers and all calls are sold by customers. So market makers will always be short puts and long calls. And just looking at this data, you could see that that is not the case. There's a data feed by the CBOE that costs almost $23,000 a month to get this information. And the CBOE assigns what positioning is which. And a lot of the other companies out there, they don't do that. They just use the naive approach, assuming that puts are bought and calls are sold by customers. So this is the real positioning of the market makers for each day. So now I'm just going to go over a few examples. This was from July 30th. Price right here. Price flipped from a positive gamma environment to a negative gamma environment. And if we forward in time, we sold right through that negative gamma. So this just means as price was going down, market makers were selling with the move lower. And, you know, based on that, or taking it a step further, where would a potential stopping point be? Okay, well, where's the positive gamma below us? It was down here. So if we sell through this negative area, I would expect price to find some type of support in the 63.40 to 63.30 area. And if we forward through time, we got right to 63.40, which was where the gamma peak was. And if we take a look even further through time, that is right where the bounce happened. So we sold through the negative gamma, went to the area where we had most positive gamma. So market makers will be buying the most down here. We found support. We bounced. We found support again right at that area. And then we flipped to the negative gamma environment and we had this sharp reversal higher. So this is just showing, big swings through negative gamma, high positive gamma will be support. And because we know this well in advance, there's a lot of big players out there that put these 0 DT iron condors on. So this was one of the days where they put a position on. So 69.25 and 69.15 were their strikes. Their upper strikes, 68.50 and 68.40 were their lower strikes. So we opened the day here. We couldn't get above this positive node, kept failing, sold through. Where did we end up? At their lower strike, the lower positive node. And that's where we found buying and we moved higher from it. Another example, price opened somewhere down here, moving up through these negative gamma strikes. Where did we find resistance? Right at the largest positive strike in the area. And we struggled to break through it, and then we sold off. Another one, price opened down here. We moved towards the highest positive node. Rejected, 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 moved lower. And then on the next test, we finally got some good buying to push us through, indicated by these blue bars. And then once we're above it, it should act as support. So we broke above, came back down, held it, and then moved higher from it. Same thing with this one. Market opened, I think, somewhere over here. We know that this, this blue bar is here. So if we start moving higher, that's where I would expect price to go. Resistance, resistance. Tried to hold it again, but enough buying came in, broke above it, and now it will be support. It held 1, 2. This kind of broke below it. These aren't perfect, but held it here, held it here. Yeah, another one. Market opened, got some good selling through this positive node, sold, got a bounce. Where did the bounce go to? The positive node, sold from it, bounced again, sold from it, and then we finally got enough buying to push us through, held it, moved higher, retest, tested it again, held it, moved higher. This was an example from, I believe this was Wednesday. So I knew in advance that these positive nodes were up here. So, if we got above this one here, acted as resistance here, and we finally got above it and held. So if this one cleared, I said slow grind higher to these strikes. And if we forward through time, so this was at 9:43. At 11:07, it's still in play. This node was holding support, or really support, then resistance, and then got above it, held here. And I'm pretty sure we ended up getting to like 68.46 maybe. And this node was at 48, or we might have gotten higher, I forget. But once this positive node holds, price should rotate higher to this one. This one, in this case, was acting as the magnet. And I'm not sure if we ever broke above it or not. I forgot what happened that day. But yeah, I hope that all made sense. I know options and all this stuff is very confusing the first time you're hearing about it. But like I said, this stuff is 0 DTE volume is so much now that a lot of times the hedging behavior is actually driving the price. And yeah, it's really important to pay attention to. And I think anybody who uses this could get value out of it in trading ES. Um, but yeah, hopefully it all made sense. If anybody has any questions or wants another video on any other topic about gamma or options positioning, just let me know. And yeah, hope you enjoyed.